Imagine waking up on a Monday morning without the pressure of a commute, having the absolute freedom to choose how you spend your time, and knowing that your financial future is completely secured. What if I told you that retiring in 10 years is not just a pipe dream for the ultra-wealthy, but a realistic goal that anyone can achieve with the right strategy? Today, we are breaking down the exact blueprint to stop working in a decade, covering everything from aggressive saving rates and high-yield investment vehicles to optimizing your taxes and building passive income streams. Whether you are starting from scratch, have some money invested, or are looking to accelerate your path to financial independence, this video will provide you with actionable steps and eye-opening concepts that the traditional financial system doesn't want you to know. Let us dive into the mechanics of early retirement, explore the numbers behind the magic, and build the real plan that will allow you to take your life back. Part 1. To determine the exact amount of money you need to stop working in 10 years, you must first calculate your financial independence number using the foundational principle of the 4% rule. This rule dictates that once your investment portfolio is 25 times your annual living expenses, you can withdraw about 4% annually adjusted for inflation without ever running out of capital. To begin, you need to track every single dollar you spend in a year to establish a baseline of your true cost of living. Subtract debt payments you will have paid off by the time you retire, such as a mortgage, and add projected expenses like travel or healthcare that might increase once you leave the workforce. This calculation gives you a crystal clear target rather than a vague idea of how much money you need to sustain your lifestyle without relying on a traditional job. Moving beyond basic expenses requires factoring in the variables that can derail early retirement, particularly inflation and the difference between your gross and net income. For intermediate and advanced investors, relying solely on historical inflation averages can be a trap, especially with rising costs in sectors like housing, education, and medical care. You should calculate a personal inflation rate by looking at the goods and services you actually consume, rather than relying on the general consumer price index. Furthermore, you must account for taxes on your investment withdrawals, which means your true target number must be higher to ensure you maintain the same purchasing power after taxes. By analyzing your future tax bracket and the types of accounts you hold, you adjust your target number to reflect the net capital available to you, preventing a shortfall during market downturns. To turn this calculation into an actionable plan, you need to break down the total number into manageable, progressive milestones that fit a 10-year timeline. Calculate your current net worth and determine how much capital needs to be generated through savings and how much through compound interest over the next decade. If your target is $1 million, for instance, you can use the rule of 72 to understand how your investments will double over the period, showing you exactly how much you need to contribute every month to reach that threshold. By establishing these interim milestones, you create a psychological framework that rewards consistent contributions and allows you to adjust your portfolio as your income grows, ensuring your target number remains realistic regardless of market volatility. Part 2. Achieving financial independence in a decade requires a radical shift in your savings rate, pushing beyond the traditional 10% to 50% or more of your income. To start this process, you need to adopt a frugal mindset without sacrificing your quality of life by targeting your largest expenses, which are housing and transportation. By house hacking or downsizing your living space, and relying on public transit or used, reliable vehicles, you can free up massive amounts of cash flow every month. This freed up capital goes directly into your investment accounts rather than being absorbed by lifestyle creep. The goal here is to live on a fraction of your income, while your savings rate becomes the primary driver of your wealth accumulation in the early stages of your journey. For intermediate and advanced savers, maximizing your wealth means leveraging tax-advantaged accounts and automating the entire saving process. You should be maxing out your traditional or Roth individual retirement accounts and employer-sponsored plans like a 401k, which shields your money from immediate taxation and allows compound interest to work on the gross amount rather than the net. Furthermore, integrating a health savings account adds another layer of tax efficiency, acting as a triple tax-advantaged account that can later be used for medical expenses or even as a retirement vehicle. By setting up automatic transfers that move these funds to your brokerage or retirement accounts the day your paycheck lands, you remove the psychological friction of deciding whether to save or spend, ensuring consistent capital allocation. Taking action with these aggressive saving strategies means constantly finding ways to expand the gap between what you earn and what you spend. If your income grows, instead of increasing your housing or vehicle costs, you should immediately direct that extra money into your investment accounts. This practice, known as saving your raises, accelerates your progress exponentially because it maintains a low baseline of living expenses while significantly boosting your monthly contributions. By treating your savings as the most important bill you pay each month, you build an unstoppable momentum that transforms your financial trajectory and sets a firm foundation for the next stage of your retirement plan. Part 3. To build the bulk of your retirement wealth over the next 10 years, you must harness the power of index funds, which allow you to own a piece of the entire market rather than betting on individual companies. For beginners, investing in an index fund that tracks a broad market index provides instant diversification and relies on the historical growth of the strongest companies in the economy. The power of compounding comes into play when you consistently reinvest all dividends and capital gains, allowing your money to grow exponentially without your active intervention. By avoiding the temptation to pick individual winners or time the market, you eliminate the emotional stress of investing and align your returns with the broader, long-term upward trajectory of the global economy. For intermediate and advanced investors, optimizing your index fund strategy requires careful attention to expense ratios, turnover rates, and tax efficiency. You should look for funds with incredibly low fees, as even a fraction of a % difference can eat away at your compounding returns over a decade. It is also essential to understand the difference between mutual funds and exchange-traded funds in terms of tax efficiency and trading flexibility, utilizing the latter to minimize capital gains distributions that can create unexpected tax burdens. Furthermore, if you are looking to manage risk as you get closer to your 10-year retirement goal, you might implement a core and satellite approach, keeping the vast majority of your portfolio in broad market index funds, while allocating a small percentage to sector-specific funds or dividend growth portfolios to boost your incoming cash flow. Taking action with this knowledge means opening a dedicated brokerage account, setting up automatic monthly investments, and strictly adhering to a buy and hold strategy regardless of market volatility. You should set your dividends to automatically reinvest and review your portfolio no more than once or twice a year to rebalance your asset allocation if it drifts from your original plan. By utilizing dollar cost averaging, you purchase fewer shares when prices are high and more shares when prices are low, smoothing out your purchase price and taking advantage of market corrections. This disciplined approach removes human error from the equation and ensures your capital is compounding effectively day in and day out, bringing you closer to your retirement goal every single month. Part 4. Generating consistent passive income is the cornerstone of early retirement because it replaces your active earned income with cash flow that requires minimal daily effort. For beginners, the easiest way to start building this income stream is through dividend-paying stocks and real estate investment trusts, commonly known as REITs. By allocating a portion of your portfolio to these assets, you receive regular quarterly or monthly payouts without needing to manage physical properties or businesses yourself. The key is to reinvest these dividends in the early years to compound your returns, allowing your income-generating assets to grow larger before you actually need the cash flow to cover your living expenses upon retirement. For intermediate and advanced investors, scaling passive income involves creating systems that produce higher margins, such as real estate syndications, rental properties, or digital assets like online courses and automated affiliate websites. These methods require upfront capital or specialized knowledge, but they offer significant tax advantages and high cash-on-cash returns compared to standard equities. You can leverage property management companies to keep the income truly passive, or build digital businesses that run on automated funnels. The goal here is to diversify your income sources so that if one stream underperforms, your retirement lifestyle remains completely unaffected and secure. Taking action with these passive income strategies requires a systematic approach to allocating your time and resources over the next decade. Start by dedicating a few hours each week to researching and setting up your first stream, whether that is purchasing shares in a dividend-focused exchange-traded fund or acquiring a small piece of a rental property. Once the stream is operational, focus on optimizing its efficiency, reducing your management overhead, and automatically reinvesting the proceeds until you reach your 10-year threshold. This deliberate focus on building alternate cash flow streams ensures that you are not solely dependent on a traditional job when you finally decide to hand in your resignation. Part 5. When planning to retire in 10 years, mastering tax optimization is essential because it dictates how much of your wealth you actually get to keep. For beginners, the main challenge is understanding how to access retirement accounts like a traditional individual retirement account or employer-sponsored plan before the standard age of 59 and a half without incurring heavy penalties. One of the most effective methods to achieve this is the substantially equal periodic payments rule, which allows you to take penalty-free withdrawals based on your life expectancy. Alternatively, you can begin utilizing a Roth conversion ladder by transferring funds from a traditional retirement account to a Roth account, paying the applicable taxes in that year, and allowing the funds to season for 5 years before making penalty-free withdrawals. For intermediate and advanced investors, tax optimization involves strategic asset location and the manipulation of your taxable income to minimize capital gains and dividend taxes. You should hold your most tax-inefficient assets, such as high-yield bonds or actively managed funds, inside tax-deferred accounts, while keeping highly tax-efficient assets like broad market index funds in your standard brokerage accounts. Furthermore, by carefully managing your total income, you can take advantage of the 0% long-term capital gains tax bracket. This requires balancing your withdrawals between taxable, tax-deferred, and tax-free accounts to keep your adjusted gross income within the thresholds that allow you to pay the lowest possible tax rate. Taking action with this knowledge requires creating a detailed withdrawal plan that maps out exactly which accounts you will draw from during each phase of your early retirement. Calculate your estimated annual tax liability under different scenarios, and work with a certified professional to ensure your strategy complies with ever-changing tax laws. By automating your tax planning and keeping meticulous records of your cost basis and contributions, you minimize the risk of surprise tax bills that could deplete your early retirement fund. This proactive approach ensures that your hard-earned money continues working for you, allowing you to maintain your desired lifestyle without working. Retiring in 10 years is not a matter of luck or a massive inheritance, but the direct result of calculating your financial independence number, saving aggressively, and letting compound interest work in your favor. By implementing the strategies we discussed today, you are taking control of your financial destiny and building a future free from the 9-to-5 grind. If you found this information valuable and want to continue learning how to grow your wealth and achieve financial freedom. Make sure to hit the subscribe button and turn on notifications so you never miss a video. I would love to hear your thoughts on this journey, so please leave a comment below sharing your favorite takeaway or a phrase that inspires you to start building your early retirement plan today.